How did subprime mortgages cause the 2008 market crash? Imagine a house of cards built on shaky ground. When the bottom starts to wobble, everything above it can come crashing down. That's pretty much what happened in 2008. The story begins with a type of home loan called a subprime mortgage. These loans were given to people with poor credit scores or unstable incomes who normally wouldn't qualify for traditional home loans. To make these loans more appealing, lenders often offered very low initial interest rates that would reset to much higher rates after a few years. Many borrowers didn't realize how much their payments could increase, making it hard for them to keep up. Lenders relaxed their standards and approved these risky loans with little documentation or income verification. Sometimes they even inflated borrowers' incomes to help them qualify. The idea was that rising home prices would keep going up forever, so people could refinance or sell their homes at a profit if they needed to. But this was a risky bet. These loans were then bundled together into complex financial products called mortgage-backed securities and collateralized debt obligations. These securities were sold to investors all over the world, often with high credit ratings that didn't reflect the true risk. The process of turning these loans into securities is called securitization. It spread the risk across many financial institutions, but it also made it hard to see how risky the investments really were. When housing prices peaked and then started to fall, many borrowers couldn't refinance or sell their homes to pay back their loans. Defaults began to rise rapidly. As more people defaulted, the value of mortgage-backed securities dropped sharply. Banks and investors holding large amounts of these securities faced huge losses. Because many of these institutions borrowed heavily to buy these risky assets, the losses were magnified. This practice is called leverage. The more they borrowed, the worse the losses became, leading to a liquidity crisis. Banks couldn't sell assets fast enough to cover their debts, and confidence in the entire financial system started to crumble. The crisis worsened because regulators didn't keep a close enough eye on risky lending and complex securities. Some government policies also encouraged lending to higher-risk borrowers, although that wasn't the main cause. As the crisis unfolded, many financial firms failed or needed government bailouts. Housing prices plummeted, millions of people lost their homes, and the stock markets took a nosedive. The 2008 market collapse shows how risky lending practices, combined with complex financial products and weak oversight, can cause a chain reaction that shakes the entire economy.